Hello, welcome to today's Advisor Q&A. I'm Tony Kay from InvestSMART. I'm joined as usual by our financial advisors, Max Noonan.
Tony.
Hi Max, and Bruce Bramall.
Hi Tony.
Thanks for coming in again.
Pleasure.
Pleasure.
Now, today we're talking about tax and your SMSF. The reason being that as well as all the various changes we know about in terms of superannuation and pensions, there's a lot of tax implications behind all of that, and it's very useful for viewers to be aware of what those changes are, and also to ask your questions to the panel in terms of your situation. We can only give general advice, but in relation to your question, we can generally work around giving an answer to your questions on that. Now, we were just talking amongst the three of us before we went on camera, and Max has some updates from a session that he went to yesterday, I believe, on people who hold unit trusts inside their SMSF. There's some issues there. So, Max, I'll put it straight over to you on that.
Yeah, there are a lot of self-managed super funds that have unit trusts as an investment. Traditionally, a lot of those have been related to property, where before they changed the borrowing rules and that sort of thing, where they allowed the limited recourse borrowing, it was not uncommon for a self-managed super fund to buy a property in a unit trust. And it's been another way that two self-managed super funds, if wanted to invest in the one property and they wanted to have an entity between them and it, they'd have a unit trust. I had thought that if there was a situation where, give an example, a unit trust held a property that it had cost $600,000, and at the 30th of June 2017 it's now worth $1 million, and that's owned by one super fund, that there would be a benefit, especially if in that super fund the member, to keep things neat, was $1 million over the 1.6. It would make sense to end up rolling back and allocating the unit trust investment back to accumulation and claim the capital gains tax relief on the $400,000, and that would fix everything. In actual fact, it doesn't fix anything because of the peculiar way that income is distributed from a unit trust. In a unit trust, the value of the property is accounted within that entity, and if we have that unit trust selling the property, it now makes a $400,000 capital gain, and it must distribute that to its unit holder, which is the self-managed super fund. So the very fact that the self-managed super fund has now got an asset that was worth $1 million doesn't alter the fact that that super fund ends up with a $400,000 capital gain, and if it does nothing else, the benefit of having revalued that unit trust is lost. Thankfully, there's one way around it, but timing is vital. In the year that a unit trust makes that type of a profit and distributes it through to the self-managed super fund, the unit trust must be wound up. Because using that example, you have the unit trust that was worth $1 million, makes the $400,000 capital gain, distributes that in cash as well as an income distribution to the self-managed super fund. When that trust is wound up, it only has $600,000 of cash to distribute to the self-managed super fund. The self-managed super fund is holding that asset $1 million. It makes a $400,000 loss on the wind up of the trust, which offsets the gain that had to be distributed. So it's vitally important for any subscribers and viewers that if you're in that situation, that you cannot expect to get the benefit of having done that revaluation at the 30th of June through a unit trust, unless you're prepared to go to that next step of winding up that unit trust upon the sale of the investment. So vital, important step if you actually want to get these concessions working for you.
Right. Yeah, thanks for that, Max, because I know that many of our listeners will have some sort of a structure or potentially have some sort of a unit trust structure within their SMSF. So very important information there. Now, as usual, I'm going to go to questions. We've had a number come in beforehand, plus there's still plenty of time to ask questions. We'll always try and get your question today. If we can't, we'll endeavour to answer those through the InvestSMART website and Eureka Report website. So bear with me, I'll just pull out my paper here. Then I'll revert to my laptop once I've run out of this. So the first question is, it's around an investor who has two properties outside of their SMSF. One's worth $750,000, the other worth $300,000, so just over $1 million. Inside their super fund, they've got about $700,000. At some point, does it make sense for this person to potentially sell one of those properties outside of the super fund and get the cash into their super fund to get the tax-free benefit in retirement?
Well, yes, it does, but there's a lot of questions that need to be answered there, which we don't have the information for, such as how old the person is, how much money they can get into super.
Person's in their mid-50s.
Mid-50s. So, partly about the tax. There's going to be some capital gains tax to be paid on that $1.05 million worth of property. We don't know how much that is, but let's assume it's $150,000, which leaves about $900,000 to go in. What you're trying to weigh up, obviously, is the cost of that capital gains that you've got to pay versus future capital gains that you may or may not pay. If you don't sell it and hand it on to your kids or grandkids, it becomes their tax issue rather than yours. But if you sell it now to get the money into super, then there's a CGT event, and you've got to pay the tax, effectively on the way as you upon sale, but similar time to when you're putting it into super. Versus, what assets are you going to buy in super? Do you want to buy another property inside the super fund? If you do want to buy another property in the super fund, then are you going to have that ability to be able to hold the property for an extended period of time, so that when you do get to sell it in pension phase with no tax payable on it, has it sort of made up for the fact that you're going to have to pay CGT in 2017, 2018, whenever the property is sold? So there's a few things that are competing there. Often, if there's not much in the way of capital gains, it's in they've bought the properties in recent years for $800,000 or $850,000, and there's only $250,000 worth of capital gains, and there's going to be a bit of a tax bill there. But you can get that money into super quickly and allow yourself some 10 or 20 years to be able to have properties inside the super fund to be able to grow and not pay any tax on CGT if it's ever sold, and that's another consideration. Also, are these properties residential or are they commercial? If they're commercial properties, then there's the possibility of getting them into super in specie, which can't be done with residential properties. So there's stuff there that needs to be weighed up. You need to either sit down and do it yourself, which opening up spreadsheets and trying to work things out, or sit down with an advisor who can talk you through the issues and try to help you, calculate roughly what the tax positions would be, and work from there. But look, it can be a great idea, but the upfront cost is twofold. It's the CGT to sell, the sales cost of selling the properties, and then when you do get the money into super, if you're buying property again, another set of stamp duty that needs to be paid. So there's a lot of costs, but so the payoff, if there is going to be one, is going to be medium term, maybe longer term. But it's something to consider.
Yeah, I agree with Bruce, except that coming at it from the tax practitioner's point of view, and I'm just trying to remember, with this carry forward being of the unused $25,000 concessional limit, you can do that for 5 years.
Yeah, it doesn't kick in until the 1st of July next year.
So we've got someone now who's in their mid-50s. Ostensibly, it all comes down to timing. And I have lots of clients that come to me that are wedded to property and say, our superannuation is our property. I say, well, that's all well and good. But if you look at a residential property, when you're in retirement, you need to maximise your income. And you're lucky if a residential property returns you 2.5% to 3% net after all costs. It's just a fact of life. The way you make your money out of residential property is to get the capital gain. And so one of the things that we have to work through is if they've got a number of properties, is to sell them in a structured way. As far as the timing goes, to be starting to think about that now for the subscriber, it's important that they think about that now, because one of the things they could do, let's say they'd like to retire at 60, and if they've got a $700,000 property that maybe may or may not be encumbered, let's say for the sake of it, it's only got a $200,000 mortgage or whatever. By not necessarily maximising their concessional contributions now, because it would only get a benefit of maybe 34 cents in the dollar, it makes sense for over the next 5 or so years to build up, say, $20,000 a year of unclaimed concessional contributions. They get to retirement to the point where they've got money in super that they can get tax-free because they're 60, or there's been some recontribution strategy, so that even if they're below 60, it means that they're virtually paying no tax. And the idea is then they sell it when they don't have any other income. So if there was a capital gain of, say, 200,000, it could even be 300,000, say. For the sake of the argument, 300,000, assessable is 150. They're then able to use $100,000 of their accumulated concessional contributions, which effectively means 100,000 of the assessable gain only gets taxed at 15%, and the other 50 goes on top of the rest of their income, and they're paying very little because they've got the marginal rate of 19% up to that. So,
or potentially also, Max, if it's husband and wife that owns this, then you've got double.
Yes,
potentially double that,
and
gains can be wiped
out.
So
the important thing though is to get the advice and get it now. It's not going to be good enough to be thinking about this on the eve of retirement. It's important to get those sorts of tax planning strategies in place now, so you know where you're heading and what's the best way to deal with it. And it does make sense to get the money into super, because even if they're really going gangbusters and you're making good income on it from the rental, still it's going to be assessable if you keep it outside of super.
Okay, good advice there, thank you. Now the next question is, it's actually around the unit trust topic. I've invested into a commercial property through my super fund under a unit trust structure. I'm in my mid-50s. The trust has just started paying me a monthly income distribution. I purchased 2 units at 100,000 each about 6 years ago, and they now have an estimated value of about 330,000 each, according to the developer. If I hold my units until age 50, what are the capital gains tax implications when I sell?
First problem is, I don't know whether you've heard about the greatest lies in history is one of them is, I'm from the government and I'm here to help you. And I'm beginning to wonder, though sometimes valuations by developers sometimes fit into that category. Let's say it is the 350,000 market value. Again, timing and everything will be important. The beauty is the unit trust is held by the self-managed super fund. Clearly the person is still working, so the super fund is in accumulation. Ideally, the time to be selling it is when the super fund is in pension phase. So therefore, if they're in their mid-50s now, and they have the ability to delay the sale of the units or the underlying property or whatever happens, is that is delayed until they have met a condition of release, which, if they decide they retire at 60, well, they've met a condition of release. If they decide they wanted to work after 60, but they're not really happy with their current employer and they're reasonable marketable on the employment side of things, is that once they turn 60, cease with their employer, again, condition of release is met, start an account-based pension, and then the property in the unit trust would be sold, and that profit, like in that when we started, flows through to the super fund, and there's no tax payable. So again, timing is all important.
Yeah, very much so.
Yeah, it's a timing issue. Yeah, sitting down and working it out and working through the example, but also that's a pretty spectacular valuation on that uplift on that property. So
Are you doubting the developer as well? I mean, how dare you?
I think I said in last month's webinar of my thoughts on developers and pricing in regards to that. So I'll leave that there for now. Yeah.
All
You're
right,
into the
Bruce.
lesson.
Now, the next question is, I've made a super contribution from my small business and intend to claim it off my 2017 business income tax return. Do I label it as a non-concessional contribution on my SMSF annual return?
I read this question earlier, and there's a couple of things that are missing here, but also a lot of misunderstandings from a lot of people in regards to this. Well, we don't have enough information to answer the question properly, but if you are self-employed, truly self-employed, and you're not paying yourself a PAYG income from it, so that is you taking distributions from the family trust or whatever at the end of the year, then you need to make the contributions personally. So you're making them not from the business bank account, but from after it's been paid out to you personally, and then you're making the contribution. That were the rules up until the 30th of June. As of the 1st of July, we have a different set of rules on how you can do that. But if they're making it from the business bank account, I've seen a horrible example of this happen recently, where time and hours spent trying to get it sorted out and prove wasn't to a self-managed super fund, but proving to a retail fund what had actually gone on. Is that businesses are supposed to pay SG essentially for the employees. So if this person is an employee of their super fund, employee of the business and paying themselves a salary from there, then there should be 9.5% paid by the employer on behalf of the employee, even though it's a self-employed person. If there are other contributions being made, then they need to be labelled correctly as well, in order for the business to be able to claim the tax deduction for those super contributions. Whether you put them in, and that's where it gets tricky to answer this question, is do I put them in as an NCC? Well, no. If it's coming from the business, it depends on where the tax deduction is being claimed as to where you're how you're putting the contribution down. If in that first example that I was doing, that the person is making it from the person is claiming a tax deduction from outside of super, as in there's a trust distribution or something, that person then makes the contribution to their super fund from their own personal money, then generally it goes in as an NCC to start, and then a form needs to be filled out post 1 July, so after the end of the tax year, but before you put in your tax return, to say that I'm going to be claiming a tax deduction for that. It's I've forgotten the section. There's a specific form for it anyway. I've forgotten the number for it, unfortunately. But that form needs to go back into the super fund and be signed off and sent to the tax office before the individual puts their tax return in. It's horribly complex. Whoever this person is who's asked the question needs to get on the phone, because we just don't have enough detail to be able to answer that.
I think from the question, I think I can give a bit more of an answer to that. And Bruce is right about the fact that we've got this new landscape as far as personal deductible contributions. And the person is lucky that this is probably happening after the 1st of July. And it's interesting that you said you've had this problem where an amount's come out of the business and trying to work through with a retail fund, and I come across this time and time again. But in the end, it's not insurmountable, because if you've had a business that there's let's say $30,000 has gone from the business to the super fund, and the owner of the business is employed by the business, and at that point in time there'd been no SGC super contributions, it's simple enough to be able to get back to the retail fund and say, well, of the 30,000, X amount is the superannuation guarantee contribution, and the balance is salary sacrifice. The other thing that can happen, like even after the 30th June, in the new situation, you could be letting them know, well, the amount that relates to the SGC is there, and the other amount is a personal contribution. And that's simply done within the books of the business, whereby, let's say it was $10,000 is the SGC, and 20,000, it's only going to be 15,000, but for the sake of the argument, is that within the books of the business, the 20,000 is shown as a loan, drawing whatever you want to the individual, so it doesn't hit the profit and loss of the business, and that's why you can end up having that go through as a deductible personal contribution. getting to the heart of the question, in the tax return for the self-managed super fund, it needs to be shown as a concessional contribution. If the member is in some way getting a tax benefit,
Yep.
which is why it's concessional, there's a concession, a tax concession got from it, it needs to be put on the tax return for the SMSF as a concessional contribution. And on the tax return for the super fund, you've got SGC as a box that needs to be filled out, and I think you've got the personal contribution. So it would need to be filled out in the correct boxes on the SMSF's return. And Bruce is right too, there is a form that needs to be lodged by the member with the self-managed super fund. It's a part of this paperwork bureaucracy that's been imposed on self-managed super funds by the regulations, but it would need to be a notice effectively that the individual member is saying, I have made this personal contribution and I want it to be tax deductible. But getting back to the question is, it does need to be put if there is a tax deduction being claimed as concessional. Non-concessional is purely after-tax money, and if the member doesn't want to get a tax benefit from it, non-concessional. But it needs to be definitely concessional.
There were initially, and the change of the rules on the 1st of July will change this a little bit. But if you were putting in money, certainly to an APRA regulated fund as self-employed, you would initially put it in as an NCC. And then use this form. It's a Section 230 form or 238, something like that. Then you'd need to put that form in, and that would change it from an NCC to a concessional contribution, because the APRA fund would send that to the tax office and say somebody's going to claim a tax deduction for this. So we're taking out the 15. Here's the form, and here's the 15% tax that should have been taken out when it was put in. So need to sit down with somebody and sort out exactly what's going on here as to where the deduction's being claimed, but unlikely, certainly highly unlikely of putting it in as an NCC at the moment.
Yeah, and this is an SMSF, not an APRA fund, so a little bit different
Well,
in terms of flexibility.
But at the end of the day, it's not an NCC if you're going to claim a tax deduction for it.
No.
Yeah.
So you need to sort that out.
And the paperwork still, effectively, yes, if you're dealing with a retail fund, you've got to fill out the paperwork, and that's the reason why SMSFs are burdened with so much paperwork, is because in the rest of the industrial world, the superannuation world, everything is done by documentation. And as stupid as it sounds, unfortunately, that's why SMSFs end up with this huge documentation problem.
All right, gentlemen, that's very good on that question. The next one is a question again about property. My wife and I love property as an investment. We own a couple outside of our fund. We've started looking at starting an SMSF, combining our super funds and purchasing a property. How much do you need available to be able to buy an investment property, and if we're prepared to take on some debt?
Can I do this one? I'd say don't do it. Right?
All right. Well, I'll say that you do possibly do it, but
we'll do it.
Max can go first.
See, the interesting thing is a property investment is great when someone is in an accumulation situation, accumulating wealth. And what a property does, especially a negatively geared property, allows people to get into something at today's dollar values with maybe a 20% or a 30% input in from them, or might even be 100% geared, but allows them to get into an investment property, and they bank on the basis of the fact that by the time they retire, that property will have increased in value. If you have a negatively geared property in your own hands, the minimum tax benefit you're going to get is 19%. And in some cases, people could be getting a tax benefit of 32.5 or 34.5 with Medicare levy, 39, or even the 47. Now, calculations need to be done, but again, on the timing of the selling of the property, if you do the numbers on the tax savings over a 10-year period, saving tax at the higher marginal rates compared to the 15% rate that you'll get a benefit of in a super fund, and again with the timing of the property being sold when the couple have retired and they can use other methods to keep that capital gains tax down, it's not very often I can see that there is a lot of sense for the after-tax calculations to do it in the fund. Especially also from a point of view of that at some point that, again, when you get to retirement, you don't want to hold on to that property because of the very low net return you get. There's got to be something happening then, and it to me makes sense to have held the property outside of super, get the tax benefits during your working life, sell it when you retire, get it in as non-concessional tax-free super contributions, and then start the money coming through from the super fund that way. That's my don't.
Okay.
What
For the other side of the equation, what we don't know here. Let's say they're in their 40s potentially, and they've owned a couple of properties. They own a couple of properties outside super, and that's why they love property. They've had it for 5 or 10 years, and they like it. They just want to replicate what they've done outside of super inside of super now, and be able to hold that property there. If they're in their late 50s or 60s, it's a different equation. But certainly for people in their 40s who are in their accumulation years, depending on how much money they have in super, it can make some sense. Now, it depends on the size of property you want to buy, but let's just assume for a second a $500,000 property. What banks are going to insist on now, with my mortgage broking hat on for a second, is at a minimum you need the 20% deposit plus your stamp duties. Okay, so there's 20 call it 26% there. A lot of lenders now have dropped back from 80% to 70%, so you might need 36%. That's as a minimum for the property itself. Outside of that, the banks want to see enough in the way of assets to be able to cope with a number of years of negative gearing, and have enough money in there to be soaking up whatever negative gearing there is. Plus, they also want to see the income coming in. So, what is the SG contributions or the overall concessional contributions that this couple is making to the fund? The lowest you could possibly see combined super balances to buy that $500,000 property is probably around the $250,000 mark, 250, somewhere around that. Might be 230, 240, might be 260, 70, depending on the lender. But that's the sort of the minimum, because if you need to have that 20% of a $500,000 property, there's $100,000. You need stamp duty of call it 6% for now. There's another $30,000. There's $130,000 that needs to go towards the property purchase, and we've got another $120,000 sitting in the fund, invested in other assets, potentially cash or shares or the like. Plus, what money is coming into the fund from the SG contributions for the assuming husband and wife in the situation. But you're getting to around that sort of figure. It would be $250,000 worth. Does that make sense at that point? Well, that's a completely separate question. But if you did have combined of $400,000 or $500,000 in super at that stage, then putting $130,000 of that towards a property purchase it can make sense. You've got a reasonable sized fund. The extra $350,000 that's invested in other assets and producing an income there can be used to offset the negative gearing. It partly comes down to age, what you're trying to achieve, but certainly the younger you are, the more sense it can make to have that property sitting in a self-managed super fund. Even if it's negatively geared, it can make sense over a longer term. The older you get, the less sense it's going to make. If you're doing this 5 years before retirement or taking a pension, where your pension fund is going to be tax free, you're going to lose the tax benefits of any negative gearing, then it won't necessarily make sense. What I'd also say, Max, just in regards to what you said there, that you need to sell the property, once you get there because the yields aren't high enough. Well, that depends on how much else you've got in the property, how much else you've got in the fund. If you're buying that property in your mid-40s, early 40s, late 40s, before 50 or so, and you're continuing to contribute to that fund for another 15, 20 years afterwards, then the property itself might be, by the time you get around to retirement, being a relatively small part of your fund. You might have paid $500,000 for it, it might have doubled to $1 million, but you've built other assets in the fund so that the lack of liquidity from a property and the lack of yield that you get from that property isn't going to be an issue in that first couple of years necessarily, if you've got other assets that you're able to sell down or that are producing reasonable income outside of the property. But
you'd agree that it would become a problem the older they got.
the older they got, certainly.
Because
but
when you get the yields, the minimum pensions go up to 5 or 6%.
Correct.
And
yeah,
they're getting
absolutely.
a 3% net yield. It can be, it's hard to start taking roof iron off the
Can't sell
the
a part of the
property
property,
to be able to. So,
but if you've got 20 years, if you're in your mid-40s, you've got 20 years until you're 65, and you're only drawing 5% there for another period of time. You might have built other assets in the fund. I think there can be a reasonable case for some people to purchasing that geared property in a fund if they've got long enough to do it. If you're purchasing at 55 or 60 and it's going to take up the majority of your fund, no, it's a completely different situation.
I think this is one of the things where in the end the numbers don't lie, and the important thing is to do an analysis based on a couple of assumptions: the earning, the income of the members, what they're going to have each year, with the effect that the current negative geared properties have on that, how much they've got in the superannuation, and you can, on the basis of, say, maybe, okay, let's factor in a 5% increase in the value of the property and a 3% increase in the income of the rent and all of those other things. It'll come down to at the end and saying, well, on the basis of these assumptions, if I have the property in the super fund, this is what's going to be the after tax situation. If instead of putting it into the super fund, I have it in my personal hands and I get to this stage and I do this is what the after tax. And the beauty is, in the end, the numbers won't lie because you've got the same common assumptions. So on that basis, if there's not much in it and someone feels more comfortable to have it in their super fund, well, it's a 50-50 phone a friend, why don't you do it? But if you do the numbers and it comes up that by having it inside the super fund, you end up being worse off in an after-tax type of situation by 50 or 60,000, you'd have to say, well, why am I doing it? So that's the beauty of it. You can, with common assumptions, work through the whole process and come up to what's going to be best. And anyone that is worth their salt can do those calculations.
Yeah, they might not have the income capacity to buy another property outside of super in their personal names. If they've got a couple of properties already, and it might be there's a separate entity there called the super fund with the self-managed super fund. But it's definitely a sit down and work through it with your situation. One of the benefits obviously is that if you do need to sell this property at some stage and you're selling it in pension stage, there's no tax to pay. If you're sitting on a $500,000 $1 million gain outside of super, when you go to sell this at 65 or 70, then it doesn't matter if you haven't earned any money that year, you're going to pay some tax on the capital gain. So there's a lot of calculations that need to go into it, but it can make sense.
I agree. The other thing too, though, is that if you're going to be looking at it, we can't afford to buy it outside of super. Let's buy it inside super because we've got, say, 400 or 500,000. I think, again, to stress test that decision is to say, okay, if we use the funds in the super fund to buy the property and we have some gearing and we assume that we've got this amount of money left and we're investing it so we're getting a net or 5 or 6% return, whatever it is, this is where we're going to be. Compared to, okay, if we don't buy that property and we invest all of the 400,000 or whatever it is in these other investments, and again, just see what comes up at the end, because I think part of the problem with most people is the decision is made on emotion and heart, and I think it's all, you need to have that as the final decider to be able to have, meet the sleep test. If something's going to cause you sleepless nights, you don't do it. But I think it's important to there's always the opportunity cost, there's always the alternative, and before making the final decision, you've got to run those numbers through for each alternative and see what comes out the best.
All right.
I'm a numbers man, unfortunately, and that's where I always.
That's all good, all good. So we've had the do's and the don'ts and the maybes, and
so in the end,
I think every case is different. You need to really do the calculations.
Yeah.
All right, thanks, gents. Just a change of topic now. We've got someone in their mid-50s who has got life insurance in their super fund, self-managed super fund. The premiums are starting to go up now, and with with the changes in concessional contributions, those premiums are going to sort of eat more into various things, I suppose, contributions and returns. So what's the advice there? What are the options?
Well, if there's a few options there. If it's a regular insurance contract with a major insurer through a self-managed super fund, be a retail contract, one of the options you have is to pull that money outside of super. Sorry, pull the contract itself outside of super. Now, not every insurance insurer will do that, but one of the options is to call the insurer and say, will you transfer the ownership of this policy from the trustees of the super fund to me as an individual. The advantage of doing that potentially is that there's no further underwriting that needs to be done. There's a contract in place. Will the insurer allow you to change the ownership of the contract to bring it outside of super? Which would mean that you'd stop getting the tax deduction inside the super fund, but at least you wouldn't be using potentially $5,000 or $8,000 or $10,000 or $12,000 to pay the premium, which is essentially coming off your new lower limit of $25,000. So that's one option. Being able to take out another contract, a new contract outside of super, just start from scratch and get your life insurance outside of super, then cancel the one in the super fund if not until you've got the new one outside of super. But there's sort of two options that you've got in order to do that. Life insurance premiums outside of super are not a tax deduction, but the money is also not taxable if there is a payout. So if it's the husband that dies with $1 million policy inside a super fund, they've got a tax deduction, and if the money is going to a dependent, to their spouse or dependent kids, then there would be no tax to pay. If it's going to somebody else, then potentially there is tax to pay. When you've got it outside of super, there's no tax deduction, but the $1 million also doesn't get taxed, right, no matter who it goes to in that situation as well. Mm-hmm. So there's sort of two options.
I agree with Bruce, but one of the first things I'd be doing is assessing. The first step is, how much life insurance do you really need? Mm. And the amount of life insurance a person needs dictated to by really two main things. The first one is, what liabilities does a person have? At the very least, in a family situation, the minimum life insurance a family should have, whether it be husband and wife, especially if it's whoever's the main breadwinner, they should have life insurance enough to pay out the liability, so that if something really bad happened to them, they can know that their family doesn't have to be looking at finding the money that's necessary to keep repaying the mortgage. On top of that, the next amount that is needed is the amount of capital that the person will need to make sure that there is a capital base within the super fund to pay an income to their beneficiaries, the people they've left behind, so their lifestyle can be maintained. Now, sometimes life insurance is just left in place without running that sort of a yardstick over it. So the first step is to work out, how much life insurance do you need? If the life insurance is still the same, there is a third alternative, or another alternative that this person can do, and I've been doing this a bit with some clients, and it even works out for someone who's a bit older. Sometimes some of these older life insurance policies, depending on when they were taken out, can be fairly inefficient and fairly expensive by comparing them to the modern things that are out there. If the person who has the self-managed super fund and the super fund is receiving SGC contributions, another option is to become a member of an industry fund. One that comes to mind that I use a lot is Australian Super. You can become a member of Australian Super. If you are a new member and Australian Super will be receiving SGC contributions, there are no tests. There is a maximum of $600,000 of super that can be entered into without tests, insurance, without the tests. If there is a pre-existing illness, if someone passed away within 2 years, all bets are off. But if the person has a pre-existing illness, and as long as they're going to last for more than 2 years, they could find that they are still in the superannuation side of things. They've been able to reduce the premiums because of the buying power of someone like an Australian Super or another industry fund, and then have their either personal tax deductible contributions or the salary sacrifice contributions going to the self-managed super fund. It's an area where the person really needs to get the professional advice if they can't do those sorts of calculations first to say, here's how much life insurance I really need. And then to just, again, it comes down to running the numbers on the alternatives of keeping with that policy and looking at what that premium's going to run up for the next 10 years and keeping it within the self-managed super fund compared to look at some of the other alternatives, either taking it out of super or starting up an account with an industry fund or something like that.
Okay, good. I'll move on to the next one. Thanks, Max. Thanks for that. Next one is in relation to the $1.6 million cap.
Haven't heard of it.
Haven't heard of it.
New? Is this something new?
I think it's fairly new.
Right.
We'll do something on that next time. But under lifetime annuities, the listener is asking about multiplying the annual entitlement by a factor of 16. We have covered this before. What does the 16 actually relate to? How have they come up with that number, 16?
I'm not sure how it applies to lifetime annuities, but certainly when it comes to defined benefit funds, there's the factor of 16.
Yeah, I think that's what it is.
But no, I don't think there was any particular rhyme or reason about it. It was just
this is all about new reasonable benefit limits, right? The Mandarins or whoever came up in Canberra came up first of all was saying we believe $1.6 million is a reasonable limit for someone to have in a pension fund, right? Looking at the other side of the equation, they said, okay, so what's a reasonable amount that a person should be getting as a pension on a yearly basis? 100,000. Because they brought in those rules relating to defined benefits that you can have a pension up to 100,000 and not have the problems. So it was a simple matter. If you divide the 100,000 into 1.6, that's the 16 times. So that's where I believe it came up, that you've got to start with what they thought was the end, which is the 1.6 million pension balance or the 100,000 pension, and that came up with the 16 multiplier. So that where if someone has a $50,000 lifetime pension, that came up with the 800,000, and then they could have an extra 800,000. That's what my understanding is. That's how they came up with that 16 times multiple.
Yeah, it's probably more around the 100,000 than the 1.6.
Yeah.
To be honest, it's 100. What are we going to allow people to have tax free? $100,000. After that, they've got to pay some tax. Yep, fine, all right. Well, how do we do that? That is, it comes to a straight yield of a bit under 6% or so. If you're multiplying that by 16 to get the 1.6, but it was around that sort of. It was a bit of a chicken and egg. Did they come up with the 1.6 first or the 100,000 first? It was, but they didn't sort of sit down and explain. They've never explained.
Yeah, they
why.
haven't explained that, have they?
No.
I mean, I've heard the rational example or the rational reasons. It seemed like a good idea at the time.
As most things do.
Yes.
Now, the next question is, this is an interesting one, well, from my perspective anyway, and from the listener's perspective. My wife's a lecturer at university. She has award super contributions rate of 17%, which can't be decreased, they've been told. Those contributions take the person over the 25,000 annual contributions allowance. And both of their balances are above 1.6 million. So what happens to those extra concessional contributions?
Well, you end up paying extra tax on whatever goes over the $25,000. There's also whatever's above the $25,000 will go towards start counting towards their non-concessional contribution limit, and then it gets taxed there at closer to marginal rates of tax when it's announced. But you also got to 17%. What sort of income are they on? Are they above the $250,000?
I actually came across something exactly. I had a phone call with a client yesterday, and they're on $200,000 a year with one of the universities or something like this, somewhere near the top. So you're looking at $34,000, and there's nothing they can do about it. So that $9,000, my understanding is, and it's interesting because the 25,000, and you can make concessional contributions when you're over the 1.6, so we can get out of that. And but it has to be treated as an excess concessional contribution, and is the choice they can either have it come out of the superannuation fund and it gets taxed at their marginal rates, or it stays in the super fund, gets taxed, and it becomes a non-concessional. Now, given that we've now got the 1.6, I don't know whether that choice will still be there.
Yeah, it might not be.
So it's a really interesting question.
It is an interesting question.
And I don't even know whether the powers that be in Canberra have thought through that. But yeah, it's in the end, it either has to come out, but what the final analysis...
Well, as you're not allowed to make NCCs anymore, then presumably...
Yeah, so that's going to be... Maybe everyone will want to become university employees and be able to get more money, and if they've got more than 1.6, because some of it will be classed as non-concessional and can stay there. Don't know.
I don't think I've read an answer to that one.
No,
actually. Despite what I said before, that I hadn't thought about the
being able to 1.6
1.6
while you're still working isn't the issue.
You can't make non-concessional contributions, and normally a person has the choice if they've exceeded the concessional rate that they can either, I don't know whether they pay it personally or the super fund pays it, and then it becomes non-concessional unless they've exceeded their non-concessional in that year. If their non-concessional limit is 0 because they're over 1.6, what happens?
Perhaps they, I haven't seen anything to suggest they do this, but perhaps they make some sort of distinction between voluntary NCCs and involuntary NCCs. In this case, it's not a voluntary NCC, it is an involuntary one. They don't have a choice, it has to go in. So have they made, I haven't seen anything to say there's going to be some sort of difference.
Thought of it. I don't think they've,
they have to have. They have to have, I reckon. There's just too many people who are on those sorts of deals. You know, there's tens of thousands of, certainly thousands, probably tens of thousands of people who have who work at universities or education institutions that get this 17%. It's pretty widespread. I've come across many a year of them, but no, I haven't.
That's based on a very brave assumption that what comes out of Canberra in the form of legislation is supposed to make sense and cover all sorts of bases. So, I wouldn't be surprised if that hasn't.
Well, but look at the public service. The public service gets 15.4% put into their super funds. So there you've got going into the PSS or basically anywhere nowadays. In recent years they've changed it. You can put that 15.4% into a self-managed super fund, which I know you couldn't do 7 or 8 years ago, but apparently you can now. But that's going to cover a lot of public servants, that 15.4%. And once they get to a bit over 150,000, maybe 160 or 170,000, they're going to be topping over the 250 as well.
I think the light bulb's just gone.
Sorry, $25,000.
The light bulb's just gone. It's
my head or yours?
Mine, being often having been a conspiracy theorist, this is the sneaky, under the table way that the politicians and the public servants can get more into super, even if they're over the 1.6 as a non-concessional. That's the only explanation.
That's
where
interesting.
We poor mortals might not be able to do it because we're not on that huge contribution. So
yeah,
unless we form our own political party.
Yes, in fact, I've got the name of it. We're going to call it the PIP Party.
PIP.
Yeah, the politically incorrect party. I think it'll take off.
Oh, well, we qualify.
Yeah,
we qualify. Let's move on. We've got some more questions and we're running out of time. This is a technical one, as several of them are, but the members got $2 million balance, 1.6 million will be in pension, 400,000 accumulation, okay. Can the member withdraw the maximum pension for 2018 and then draw out a lump sum of 250,000. I think this might be leading towards a recontribution type arrangement. Draw out a lump sum of 250,000 against a pension, then top up the pension balance from the accumulation account with 250,000.
Possibly.
Yeah.
It's important, and see, there's some confusion because if the person is on an account-based pension, there is no maximum limit. That only applies to a TRIS. So therefore, not sure where the maximum pension comes. But if they're drawing their minimum pension, I would have thought, if they're drawing their minimum pension and they wanted to take an extra 250,000 out, it's not done as a lump sum, because a lump sum could be a pension payment. It needs to be done as a lump sum commutation, because commutations of the pensions are one of the few things that decrease the pension transfer balance account. So as long as the 250 comes out as a partial commutation, you'll have the situation where they started off at the start of the year with 1.6. The minimum pension's been paid. That doesn't affect the 1.6. The 250 commutation lump sum's taken out, so it goes down to
1.35.
1.35. They have the money, the 400,000 in their accumulation account. They can roll another 250 back in, brings it back up to the 1.6. The only question I ask, what have they done with the 250 that's come out? Have they started a crack habit? And what have they done? Have they paid off? I mean, it's interesting, yet you've got to look at the other side of the coin. What happens with the 250 that comes out?
If they're looking to recontribute it, then it's a different story. If they are looking to bring the money outside of super using strategy I wrote about in December, the 3 pots strategy, then did they need to do that? If they had the 1.6 million in there, rather than take the 250 out of their pension fund as a commutation, as a partial commutation, why didn't they just take the 250 out of their accumulation fund, assuming that they can, and take that out into their personal name and invest it out there? The 3 pot strategy is that 1.6 million in your pension fund. The second one is an amount of somewhere between $500,000 and $1 million outside of super in your own name, where if you're earning 3% or 4% out there, will keep you under the 18,200, a little bit higher than that with various allowances, but it'll allow you to stay under that and have that money tax free potentially for husband and wife. And then your third pot is being back inside the super fund in accumulation, where it's going to be taxed at a maximum of 15%. So not quite sure.
You've got to work out what they're trying to do.
Yeah,
what are you trying to achieve? If it was a recontribution strategy, fine. Take out the lump sum, have the money go out, come back in. The problem is then if the $400,000 that's sitting there is taxable, 250 would come back in as long as they haven't exceeded the non-concessional contribution limits in previous. It means that then when they roll the 250,000 back into the pension phase, yes, they have increased the tax-free component, but not markedly. But they will have helped a bit. If the 250,000 is required for a world tour on the QE2, or if it's just needed for money for spending purposes, Bruce is right. Why would you be taking it out of the pension phase? You'd take that out of the accumulation.
The general strategy behind this is going to be, for most people, depending on some other things, that'll be different for everybody. But if you have in excess of the 1.6, you've got some money that you weren't able to put into your pension fund, you've got sitting in your accumulation fund. You take your minimum pension first, 4%, 5%, whatever it happens to be. Whatever money you need in excess of that, you're probably going to draw from your pension fund, depending on where the rest of your assets are. If you have extreme assets outside of superannuation, then perhaps you're wanting to use some of those, depending on capital gains tax and the like. But you're generally going to be drawing the minimum pension that you can from your pension fund. If you don't have assets anywhere else at that point, then drawing, if you need extra money, then drawing it as a partial commutation from your super fund. Why would you care if you didn't have any other assets? Well, you might get an inheritance or something. Somebody might die. Somebody might gift you some money that you can get into super. If over a 5-year period you've reduced your transfer balance account from 1.6 down to 1.4 or 3 or something like that, and an inheritance comes in, then you might be able to use that money to top up your transfer balance account. Yeah. So in general rules, you're taking the minimum pension you can. If you do need to take extra from that, you're doing a partial commutation.
Okay, good.
But interestingly, Max, during this week I was just reading about it, the decision to come out in recent weeks, or the discussion around it come in recent weeks, and that is that the ATO is going to move as part of this T-bar, the transfer balance account reporting, is you're going to need to make these decisions or what the money came out as, whether it came out as a pension or a partial commutation in what the ATO is calling real time. But one of the best ways of managing this will be to have that document sitting with your self-managed super fund that's been signed by members in a letter to trustees to say, I want to take the minimum pension this year. Anything beyond that, which will be documented at the time, but anything beyond that should be a partial commutation, just so you've got that document sitting there in case of audit.
So the document by itself, especially in this real-time reporting, it'll be interesting to see what the final regulations come out for SMSFs, because I know that the tax office has been going to a lot of consultation with many parties from the self-managed super fund world, and there's a thought that it's going to have to be 10 days after the month that the transaction happened, or it's going to be within so many days of the quarter. And the interesting thing is self-managed super funds don't need to worry about it for this 2018 year, because the reporting, the real-time reporting will not really start effectively till 2019 year, because any commutations, and they're the only things you need to report. Pension payments you don't. So it's any commutations or rollovers. They're the two main things that need to be reported. My understanding that affects your transfer balance cap is that the time to report any of those transactions in this 2018 year, you can do it earlier, but the latest you can do it is at the time of lodging the super fund's 2017 tax return. Now, the lodgement deadline for the 2017 tax returns for self-managed super funds, unless they're a brand new fund, and I think that's February or something, the lodgement deadline for SMSF tax returns is for the 17 years, 30th of June next year. So this real-time reporting, we don't have to worry about it yet. But the other important thing is if there's going to be needed other amounts to come out for our viewers and subscribers, if they can see that happening, they need to let their accountant, their reporting, the administrator, whoever it is, that this is what's going to be happening and roughly the time. Because if we're talking about this is going to be happening in 2019, they can't do it in an unstructured way, because if they do it in an unstructured way and they just take the money when they feel like it and it doesn't get reported, depending on the level of the penalty, whether it be capital punishment or a rap over the knuckles, will work out, how dire not doing the thing properly will be. But it's a bit of a watch this space. We'll know better by the time, I'd say 30th of June next year's come around, as to what the final reporting requirements will be.
I'm going to cut in there because we've got one very limited time. One more question, and the other questions we'll get to in columns if we can. Transitional capital gains tax relief. Is there a limit on the value of assets that can be revalued? If so, what's measured? What's the total value of assets? And there's
the capital gains tax relief applies to the excess over 1.6. You can't use the ability to claim the capital gains tax relief to claim relief on assets that don't need to be rolled back into accumulation.
Right.
So it's purely the excess. The only time you can do that is interesting, where we started our session today, is property. If you have a self-managed super fund with 2.5 million and it has a lumpy asset of 1.5, say, you are able to have that one asset go back and effectively have a commutation back to accumulation of the 150, which means therefore that person would end up having a reasonable benefit limit of the $1 million. And then you could claim the capital gains tax on all of that one lumpy asset. But that's the only time you can end up actually claiming a capital gains tax relief on something that's more than the excess.
Okay.
That's my understanding anyway.
Thanks, Max. We're just about on time, gentlemen, so thanks again for coming in.
Pleasure.
It's always good to have such lively discussions. We can have
Lively?
boxing gloves on next time.
This wasn't lively, this was quite conciliatory and agreeable and all that.
Well, no, it wasn't.
Just wait until we get outside.
Anyway, thanks, listeners, for tuning in. We will post that up on the website shortly, and any questions we didn't get to today we'll answer as soon as we can, probably in one of our columns, and also live on the website. Thanks again for joining us. We'll see you again next time.